Okay, so you want to own a gold mine, buy some land that has gold in it, hire some miners, dig it up, sell it at whatever the price is that week, get rich. Here's the strange part. Gold is trading at levels it has never sustained before in history. Central banks are buying it at the fastest pace since 1950. And gold mining companies right now are printing some of the richest profit margins the industry has ever recorded. Governments from Warsaw to Beijing are quietly stacking it in vaults, specifically because it's the one asset nobody can freeze, sanction, or print more of. And yet, in that exact same environment, more gold mining companies will go broke this year than will ever produce a single ounce. You can be standing on top of billions of dollars of proven, tested, geologist-verified gold and still walk away with nothing. By the end of this video, you'll know exactly why that happens, what actually has to happen to the ground beneath your feet before that gold becomes a bar in a vault, and why roughly 1 out of every 5 ounces of gold mined on the planet this year was dug up by someone who technically wasn't supposed to be there at all. Most people think there's exactly one way to own a piece of a gold mine. There isn't. There are 4 doors in, and they lead to 4 completely different worlds. The cheapest door is the stock market. Newmont and Barrick, the 2 biggest gold mining companies on Earth, trade on the New York Stock Exchange for less than $100 a share, for less than the price of a nice dinner. You own a sliver of mines that are already dug, already permitted, already producing gold today. This is the boring door. It's also the only one where your downside is capped at exactly what you put in. The second door is a junior exploration company, a small public company whose entire business is drilling holes in the ground, hoping to find gold nobody has found before, often trading for pennies a share. Most never find anything worth mining. The rare few that make a real discovery can see their stock price multiply many times over in a matter of months. This door is closer to a lottery ticket than a business, but it has minted more overnight millionaires than any casino in this series. The third door is buying an existing, already producing mine outright. A small single operation pulling out somewhere around 10 to 20,000 ounces a year can change hands for tens of millions of dollars. A mid-sized mine, the kind producing 200,000 to 300,000 ounces a year, runs from the hundreds of millions into over $1 billion. What you're buying is cash flow permits and equipment that already works, not a bet on the future. It's the least exciting way in, and also the only one where you can walk the property before you sign anything. The fourth door doesn't show up on any stock exchange at all. It's a shovel, a pan, maybe a metal detector, and a government permit, if you bother applying for one. An estimated 1/5 of all the gold mined on the planet this year comes through this door, dug up by hand by roughly 40 million people across more than 80 countries, most of them in places where a formal permit is either unaffordable or simply doesn't exist. It is the least glamorous door on this list, and ounce for ounce, one of the most dangerous. No corporate safety department, no engineered tailings dam, just a person, a hole, and whatever chemicals are cheapest to get the gold out of the dirt. Whichever door you walk through, the business underneath is exactly the same. So now we get to the question that actually matters. Where does the money come from? Here's what surprises most people about this one. Unlike a casino or a gas station, a gold mine doesn't hide its profit behind some product you weren't expecting. The product is the gold. There's no convenience store quietly subsidizing the operation, no hidden markup buried in a snack aisle. You dig up the exact thing everyone assumes you're digging up, and you sell it for the exact price the entire world already knows, because gold trades on a public market, and that number is flashing on financial news channels right now. You don't get to negotiate it. You don't get to mark it up. You are permanently a price taker, which means the entire business comes down to one number that never makes headlines: what it actually costs you to pull 1 ounce out of the ground. Not just the diesel and the dynamite, but the wages, the equipment replacement, and the environmental cleanup money you're legally required to set aside while you're still digging. The industry has a name for that total figure: all-in sustaining cost. Now, that number averages somewhere between $1,200 and $1,400 an ounce across the industry. Subtract that from a gold price sitting at roughly $4,050 an ounce, and you get a gap of around $2,700 per ounce in margin. That gap has rarely, if ever, been this wide in the history of the industry. You're not really in the gold business, you're in the spread business, and right now the spread is enormous. And here's the part that breaks people's brains. That massive margin hides how strange the physical process behind it actually is. Picture the version most people imagine: shiny nuggets sitting in a riverbed, waiting to be scooped up. That is almost never what a modern gold mine looks like. Most of the gold left on Earth is locked invisibly inside completely ordinary-looking rock at a concentration so low it would be laughable in any other industry. Many of the world's largest gold mines process rock containing less than 1 gram of gold per metric ton. Imagine an entire ton of rock, roughly the weight of a small car, crushed into powder and dissolved in a cyanide solution to chemically strip the gold out, atom by atom, all to produce a nugget that would fit on your fingertip and weigh about as much as a wedding ring. Do that a few million times a year at industrial scale, and you have a gold mine. The other thing that breaks people's brains is how long it takes to even get there. Gold mines are actually the fastest major metal to develop, averaging around 15 years from the day someone finds gold in the ground to the day the mine opens. 15 years is the fast version in the United States specifically. Permitting alone routinely eats up 7 to 10 years on its own, and some American projects have taken close to 3 decades from discovery to their first bar of gold. You could find one of the richest deposits on the planet tomorrow, hand geologists proof of billions of dollars sitting under the dirt, and still not sell a single ounce before your own kids are old enough to run the mine for you. Step back for a second, because everything above assumes nothing goes wrong. In this business, plenty can. The first way to lose everything is the one investors talk about constantly. You spend years and tens of millions of dollars drilling, and the gold simply isn't economically there. This is the single most common outcome in the entire exploration industry, and there is no insurance policy for a hole in the ground that turns out empty. The second threat is buried, literally, in the leftover waste. Once you crush that rock and dissolve the gold out of it with cyanide, you're left with a slurry of toxic residue that has to be stored somewhere, usually behind an earthen dam, essentially forever. In the year 2000, a dam holding cyanide-laced waste at the Aral gold mine in Romania overflowed after heavy snowmelt, releasing roughly 100,000 cubic meters of cyanide-contaminated water into a river system that eventually crossed 4 countries. It killed enormous numbers of fish along the way, and by some estimates, threatened the drinking water of close to 2 million people downstream. It's still referred to as the worst environmental disaster in Europe since Chernobyl. Under most modern mining law, if that dam sits on your property when it fails, the cleanup liability is yours, no matter who built the dam or how long ago. The third threat isn't physical at all. It's the fact that 1/5 of your competition doesn't play by any of these rules. That informal artisanal gold, dug up without permits, safety standards, or environmental controls, still gets melted down and poured into the exact same bars, sold on the exact same trading floor as gold from a billion-dollar mine. It moves through refiners and middlemen who frequently don't ask too many questions about where it came from. You can spend 15 years and $1 billion doing everything by the book, and you're still competing ounce for ounce against gold that costs someone nothing more than a shovel. There's a fourth threat too, and it's the one you have zero control over: the price itself. Everything in this video assumes gold stays somewhere near today's number. It has not always been there. Gold has gone through decade-long stretches of doing almost nothing, and every mine plan on Earth is built on a price forecast that could simply be wrong by the time construction finishes 15 years from now. You can nail the geology, survive the permitting, and avoid every dam failure, and still get unlucky on timing alone. Time to pull it all together and answer the actual question: how much money do you make if you do this right? Let's run the math on 3 realistic versions of your gold mine. Option 1, a small operating mine producing around 20,000 ounces a year. Smaller operations tend to run higher costs, closer to $1,800 an ounce, since they lack the scale to spread out fixed expenses. At today's gold price, that's a margin of around $2,250 an ounce, or roughly $45 million a year in profit, against a purchase or construction cost typically in the tens of millions up to around $100 million. Option 2, a mid-sized single mine producing around 250,000 ounces a year, the scale of many operations currently under construction worldwide, several of which have cost close to $1 billion to build. Running at the industry average cost of around $1,300 an ounce, that's a margin of roughly $2,750 an ounce, or close to $687 million a year in profit at today's price. Option 3, a major multi-mine complex producing on the scale of 4 million ounces a year, roughly the size of the single largest gold-producing operation on the planet. At a leaner, top-tier cost structure of around $1,050 $250 an ounce. The margin balloons to roughly $3,000 an ounce. Multiply that out, and you're looking at somewhere around $12 billion a year in profit at a scale essentially no single company can build alone. That third number isn't hypothetical. It already exists. In northeastern Nevada, Barrick and Newmont, the two companies you could have simply bought shares in back at door one, eventually gave up competing with each other and merged their operations into a single joint venture called Nevada Gold Mines. Barrick owns 61.5% of it and runs the day-to-day operation. Newmont owns the rest. Together, they control 3 of the 10 best gold deposits on the planet, and the combined complex produces more than double the output of the next largest single gold mine on Earth. Run by Barrick's chief executive, Mark Bristow, it is worth, at today's prices, somewhere in the neighborhood of $16 billion a year in gold before a single cost comes out. The two companies that once tried to outdig each other decided the smartest move was to stop competing and simply own the spread together instead. Everyone else is still down in the dirt hoping the 15 years the cyanide dam and the empty drill hole don't happen to them, while somewhere in Warsaw or Beijing a central banker adds another few tons to a vault, completely indifferent to whichever door you walk through to get your ounce. In this business, the house is whoever controls the cost per ounce. Everyone else is just hoping they found gold.